I'm a multi-asset person. I don't just hold gold or silver or commodities or mining shares. I hold a lot of industrial type companies, well-known big companies, but the prices had become higher. So I've been top slicing that over the last few months, raised quite a bit of cash, and recently I've been deploying that cash into the gold and silver mining sector because what I found really surprised me. I could not believe how cheap these stocks are based on historical earnings, and also knowing that the number one thing they're selling is up in price by 20, 30, 40, 50%, depending which time scale you look at.
Friday, March 21st, 2025, Monaco 64, home of alternative economics and contrarian views. Welcome back, Clive. It's been a couple of weeks.
Well, thank you. I slightly out of action for a week or two, but I'm back here, and welcome to the first day of spring, Mario.
Yeah, it's great. The sun's shining. I had to close the curtains, which is a good thing.
And it's spring for the gold market too.
Yeah, I mean, I was talking to you before we started that the last time we spoke on the 7th of March, the price of gold was trading around 2,900. It even went below 2,900. And here we are right now, as I speak, and we're at 3,032. It's 8:37 a.m. London time. What I wanted to start with today, Clive, is China. And I saw an article yesterday in the FT talking about how, and I'll bring it up here for the viewers and you. So China raises state funding for strategic minerals amid U.S. trade war. Authorities increase subsidies for exploration and mining to shore up high-tech supply chain. And it's interesting, Clive, because sometimes people forget that all this high tech that we have, all the gadgets, and also a lot of the energy supplies that we need, they need stuff from the ground to build this infrastructure up. And I think it's becoming more and more important in terms of strategy for nations. And I don't know if you remember this, and I covered this on the channel. Yes, we were a bit early, but it's better to be early than too late. December 2022, this was Zoltan Pozsar, former New York Fed analyst and Credit Suisse analyst. He said war and commodity encumbrance. And in this, he spoke about the fact that under a multipolar world, it didn't matter where the commodities came from because there's globalization. You could buy it from China, but now the world is becoming more and more dangerous, unipolar, and unlike what Secretary of the Treasury Connolly said in the 70s, he said, I think, Clive, at a meeting of other finance ministers, when they complained about the dollar, he said, "Well, it's our currency, but it's your problem." So now Zoltan is right. He said, "Our commodity, your problem," and so I'd like to have your opinion on this. Yeah, what you think is going on and how important that's going to be for commodities in relative terms to other assets.
Well, it does seem that the demand for certain strategic metals in particular, and of course copper, is rising very sharply. I think the copper price alone has doubled in the recent years. There's an opportunity here for your listeners and viewers to get involved. Because although the prices of these rare minerals is rising a lot, there's plenty of companies around the world who are mining them, and their prices are down in the doldrums. I mean, you could take any of the large international mining companies, which you can buy in London or New York or wherever, and you'll find that the price earnings ratios are fairly low, and the dividend yield is fairly high. I mean, give you one example. BHP or Glencore, both of those have yields well above 4%, price earnings ratios down at 12 or 13 times. These are mining giants who are pulling stuff out of the ground, and commodities, this is really an opportunity for those who think that the tech space is really overpriced at 40, 50 times earnings to go into something which is a lot cheaper.
Yeah, and the other thing, Clive, is President Trump. I think he realizes that this is going on, and he signed a lot of executive orders to exploit more natural resources, rare earths, not only in the U.S. but other countries as well. I think that's why he's got his eye on Greenland. That's why he's trying to negotiate some kind of natural resource deal with Ukraine. And also the Secretary of State, Marco Rubio, he admitted the U.S. is not the top dog anymore. He said we are not, even he's mentioned the multipolar world. So the only part of the world that seems to be still asleep is Europe, Clive.
Mhm.
I mean, Europe needs to deregulate. I know Europe doesn't really have as much natural resources, but for the little that it does, it should deregulate. Like in the UK, noticed yesterday there was a story that the Norwegian sovereign wealth fund is buying Covent Garden or some part of Covent Garden in central London. Well, the thing is, Clive, we don't produce gas and oil anymore in the North Sea, so we buy it from Norway. So they've got the money and they're buying our assets. I mean, it's crazy.
And they got a sovereign wealth fund, which is something like four times the annual salary of the average Norwegian citizen per, if they divide that by the number of citizens they got. So they got a huge amount of wealth from their oil. Um, it's a great pity that Britain doesn't have a sovereign wealth fund, which they could use perhaps to fund some of their deficits. And they've got a bit of a problem coming up in the gilt market, haven't they, Mario?
Yeah, not just funding the deficit, but providing cheap energy because we got loads of the stuff in the North Sea and we got a lot of coal, the UK underground as well. Apparently, there's 300 years of coal under the surface here on the Scepter Isle, if you want to call it that. But
Did,
yeah,
did,
yeah.
did they close all the coal mines when they went on strike? And Margaret Thatcher said, enough of that, we'll close them down.
Yeah, bad idea, I think. Yeah, you're talking about the UK debt. Yeah, I saw this yesterday and I'm going to share it here. It's quite a big number. It's more than a third of $1 trillion. It's almost £1 trillion. So gilt investors brace for nearly 310 billion in debt sales. And you've read it too, Clive. And I think you noticed a comment here that I noticed as well, which is quite interesting. It's from Craig Inches, head of rates and cash at Royal London Asset Management. And he said, but any signs that the Chancellor is prepared to throw caution to the wind could prove fatal for a gilt market that is already on life support. So Rachel Reeves, the Chancellor, she's coming out with a statement, budget statement on the 26th, Clive, so next week. And basically, the fiscal situation is precarious here in the UK. And today, talking about deficit or public sector borrowing requirement, we had this number here, Clive, from the UK. And it was expected to come out at £7 billion, but we borrowed almost 11 billion. So it's not getting any better. So how do you see this evolving? And do you think Rachel Reeves has got what it takes to solve this situation or this problem?
Democracy is a wonderful thing, but the trouble with democracy is that it's very hard not to spend money on your pet project because someone somewhere isn't going to like it. And you basically got to kowtow to your voters and effectively continue spending that money, even though it's unwise to do so. So the reality here is that all Western governments are spending more than they can collect in taxes, their debts are getting larger, and the interest that they have to pay on that debt is starting to accelerate away, particularly since we've had we did have, going back 5 or 6 years ago, we had more than a decade of nearly zero interest rates, and now the interest rates are well above zero. I mean, we're talking in the UK of what's the borrowing rate at the moment, 4 point something, I think. Bank of
4.5.
England rate 4.5. The ECB is 2.5. It was a negative rate. The federal rate, which was down to a 0.25% at one point, is 4.5 to 4.25 to 4.5. So we've got much higher rates. So when governments have their debt, which they borrowed during all of this period of low interest rates, maturing, they're having to refresh that debt at a much higher rate, and that means that the interest burden on all Western governments at the moment is rising. And if you couple that with the inability to cut back on spending, and I know that America's making some efforts now, but it won't, in my opinion, it won't go far enough. But the reality is that debt is destined to continue growing. And the problem is when it grows faster than GDP, you're on a hiding to nothing, because eventually it overwhelms the entirety of the system, the entirety of the economy. So I don't think it's got a good ending unless we find a way out. And some of the ways out aren't very nice.
Yeah, and you mentioned that democracy, the government also always, oh, most of the time spends in order to please its constituents. But here in the UK, that's not even happening, Clive.
Yes.
They're cutting
Spend to please themselves.
yeah, they're cutting all the stuff they spend to the pensioners and to other people, but they're increasing war spending. There's increasing like how much they give away to Ukraine and other pet projects. But they increasing how much they spend on people who come to this country illegally. I remember Clive coming to visit the UK back in 1987. And at the time, I still only had my Brazilian passport. I only got my Italian passport a year or two later. And I came just for a weekend to visit a friend. And I was kept at Heathrow immigration office for like 2, 3 hours. They were questioning me. So, but now you come on a boat, they just let you through. They pay you for to stay in a 4-star hotel. That's a different topic. But the other thing, Clive, about the UK debt that is different from the government debt, that is very different from the rest of the West's debt, is the duration. The average duration of UK debt is like 14 years. So it's more towards the longer end of the curve. And we know that the longer end is usually higher. And I think that's a concern. I think like in the US, it's like 7 years, maybe even less. So these people who are consulted, they're called the GEMs, gilt edge market makers. They're just people, the market makers in the gilt markets. They're saying issuance above consensus or a worse than expected picture of the public finances could roil the market. Investors will also pay close attention to the broad shape of issuance set out by the Debt Management Office, or DMO, in terms of how much it intends to issue in various buckets, such as short-term conventional gilts and longer-term index-linked debt. At a meeting in January, officials and gilt edge market makers, or GEMs, primary dealers, push for a further reduction in the proportion of long-term debt sales. So is there a double-edged sword to
Well,
increasing short-term issuance at the
well, yes.
can
Yeah,
you
I it's a bit like when you're taking out a mortgage. Do you take out a short-term mortgage which matures every year or every 6 months, and you have a new interest rate and you don't know what it will be, or do you take a longer term, a 10-year or 20-year fixed rate? And I know you can't really do that in England. I think it's normally 6 years unless you're very sophisticated. You bank with a special bank, but do you take a long-term fixed rate, which is going to cost you, in general, more than the short-term rate? And that's the dilemma which is faced by a homeowner when he's taking out a mortgage. But of course, the government's got the same dilemma. Do they borrow for a longer term at a higher rate, but know where they stand? Or do they borrow for the shorter term and then might maybe get a nasty surprise in 2 years when that debt matures and they have to refresh it at a much higher rate? I think if it was me, I would certainly have a fair smattering of my debt long term, but the sensible thing is to spread it out over the entire yield curve. So you have some maturing in 30 years, some 20 years, some 10, some 5, some 3, some 2, some 1. And that way you manage your debt and your interest rate in a sensible way. But given the way I think things are going, I think we're going to see much higher interest rates down the line. And for that reason, I'd be inclined to have more at the long end than the short end. And I wouldn't be doing what it says in that article, which is going short.
So, what would you say? Because in 2022, the gilt crisis started around the end of the summer. And since October, actually, or towards the end of last year, yields have come off, which is a good thing, but uh, they're still really high, the 10-year yield compared to where it was when we had the Liz Truss crisis. What do you think is the probability we get another gilt crisis before the end of 2025? Like out of what from 0 to 10?
Well, I'd give it a 50% probability. It's certainly something which could happen. I mean, I remember back in about 1982, we could get 15, 16, 17% yields on British government gilts. I mean, seriously, well above 15%. And I remember my boss saying to me at the time, and I was a younger man there then, he said, Clive, fill your boots with this stuff. You're never going to see such high yields again. And I took his advice to some extent. I went, in those days, the way you bought gilts, it wasn't like today where you do it through online or through a stockbroker. You'd go to the post office and you'd fill in a form at the post office and pay your money across the counter. And then a few weeks later or days later, you'd get your gilt certificate in the post. So I did, in fact, fill my boots with sort of 5 and 10-year gilts, paying these whopping great rates. Unfortunately, the time came a few years later when I had a nice profit as rates had come down that I sold them, and I'm very sad to say I was selling gilts with yields of 7, 8, 9%. When if I'd kept them, they would have continued rising in price. But at least it shows you how high yields could go again.
Yeah, yeah. Should let's see what else have we got here. Yeah, I wanted to talk a little bit, and then we can move on to gold and silver, and also the miners, which you have some interesting comments to make. But I wanted to show here, Clive, and this is related to it. I did this chart here. It's the CRB index versus the S&P. So this is, you take the CRB divided by the S&P. And you can see that 2020, when we had that crash in March, that was the lowest in like a generation. And then commodities caught up by because of all the QE, money printing, and people not doing anything at home and getting paid. And then we've had a pretty sharp correction in relative to the S&P since, let's see, the middle of 2022 up until November last year, and it seems to now that there's a lot of room for commodities to move up versus the S&P, especially if we're going to see another huge bull market in commodities. And as I spoke earlier, it seems like in a unipolar world, there's going to be more and more of a rush to try to find your own commodities. So how do you see this?
Well, what this chart shows us is that either commodities are still very, very cheap compared with where they've been, or that stocks, the S&P 500 in this case, which you're measuring it against, are very expensive. But it does show us where the money's been going. The money's been going into stocks, and relatively speaking, the stock market has ballooned in value because it's on a much higher multiple than it was 10, 20 years ago, whereas the commodities, I can't say just on the spur of the moment whether they'd be going up or down, but the money has not been going into commodities. So what will happen if this tech bubble, this AI bubble on Wall Street deflates a little bit, which I think it's already doing? Where's that money going to go? And I think commodities could be a space that it'll go to. And more importantly, and I think this is something you want to come on to, I think that the gold and silver market, physical gold, physical silver, as well as the related mining shares, might be a destination for a small part of that money. But it won't take a lot to move the mining sector or the gold price a long way.
Yeah, and here I've got a CRB index on its own, and I've been covering this and looking at this.
So yeah, it's not gone up in 20 plus years.
Yeah, yeah. So it looks like it's breaking out of this little pennant, which is bullish. It hasn't really taken off yet. I guess we need to break through this level here. So, have you got some? You told me before we started that you've been actually buying quite a few of the miners in the last 2 weeks or so. I have maybe added a little bit to my miners, but I haven't really been buying new miners. But I can tell you that my portfolio, the profit on it has gone up substantially in the last 2 to 3 weeks, which is nice, but it will probably correct along the way. But hopefully, the idea is that it's over time, it's going to do well.
So, I'm a multi-asset person. I don't just hold gold or silver or commodities or mining shares. I hold a lot of industrial type companies, well-known big companies, but the prices had become higher. So I've been top slicing that over the last few months, raised quite a bit of cash, and recently I've been deploying that cash into the gold and silver mining sector because what I found really surprised me. I could not believe how cheap these stocks are based on historical earnings, and also knowing that the number one thing they're selling is up in price by 20, 30, 40, 50%, depending which time scale you look at. So, I don't want to say too many mining names, but just running through some of the stuff which I bought. There's a gold mining company from South Africa. It's on a price selling ratio of 7 times, yielding 2.42%. One of the largest mining companies in America, a giant, 50, 60 billion. On 13 times earnings, yielding 2.8. There's one I bought in Canada. It's a multi-billion dollar company. It's 10 times earnings on a yield of 3.16. There's another one in Canada on a P of 10. There's one in Australia I bought this morning. I got up at about 3 o'clock in the morning to buy it. Price earnings ratio 6.6. That's very low. Yield 4.34%. And there's a few others. As I look around the world, there are a lot of very, very cheap gold and silver mining companies. The one in Australia was a gold mining company. So what I'm trying to say is these mining stocks have been left behind in the general rise of the stock market. They are cheap now, but the thing which is more interesting for me, and what makes it much more exciting, is the product they are selling is worth an awful lot more than it was last year when these price earning ratios, because these price earning ratios are calculated for the most part on the previous year's earnings. So given that the product they're selling, gold and silver in all cases, is much higher in price, it does mean that it's likely that in many cases their earnings per share will be higher next year than they were last year. And it does mean that there's a reasonable chance that they'll raise their dividends. And some of these companies have been raising their dividends, many have not. But now, with a much higher profit coming next year, I think that the dividends are going to go up. And when you look around the rest of the world, these sorts of companies are relatively cheap compared with what you could buy in the industrial, in the rest of the market, where the average price earnings ratio in America is north of 20 times, and in Europe probably north of 15 or 16 times. And here I'm looking at companies which are broadly speaking below 15 times, and in some cases below 10 times earnings. Quite cheap.
Yeah, so what you're doing is value investing, isn't it? That's the Benjamin Graham strategy.
It, not only is it value investing, it's also making a little bit of a bet that the man in the street will wake up and start to become interested in gold and silver. And of course, some will be buying the physical metal. And we know they're not doing that yet because we only have to look at the gold ETFs in America and Europe. And the amount of gold those ETFs hold has, broadly speaking, been falling for the last 3 years. So people have been selling gold. They're not enthusiastic about gold yet in general. Of course, your listeners, Mario, are very intelligent people. You know, they're buying gold. They're listening to you because they're smart enough to know what they have to do. But the vast majority of the people who meet in the street have no clue what the price of gold or silver is, and they haven't even thought of it yet. That's going to come when their stock, the rest of their stock portfolio is falling. They start to ring up their bank or their broker or their advisor and say, what do I do? And I think in many cases, the answer is going to be, why don't you buy some gold or silver? And then the next logical step will be, have you thought about the mining sector? That's not expensive. Yes, some of these stocks which you're selling are expensive, but there's a sector out there which is very cheap. And I think that so I'm betting that over the next couple of years, money will start to migrate from the mainstream market of industrial companies into the mining sector, and particularly the gold and silver mining sector, which means that we might be, if you see, just to illustrate this, if you see, let's say, you've got a price earnings ratio of 10 on a company, and you see the earnings of that company double, which is perfectly reasonable with the way the gold price has gone, then logically you'd say the share price should double if it's still going to maintain its price earnings ratio of 10. But what if more buyers are coming into the market and they push the price earnings ratio to, let's say, 15? Well, not only do you double your money, because it's now gone to 15, you've made 3 times your money overall because you've got 3 times double earnings.
Wow. Yeah, and I think, Clive, it's not just the public that are asleep, but also professional investors. And I think one of the reasons they don't really trust the miners is that they think if we have a recession, that we're going to see deflation, and then you won't need gold and silver, and the prices are going to come down. But we've seen recently this week, Clive, that the Federal Reserve at its FOMC meeting, they came out with their forecast, and they've actually downgraded growth, but they've upgraded the PCE, which is prices. Here in the UK, we had negative GDP this that was published earlier this week. We Bank of England wasn't able to cut rates because there's still a lot of inflationary pressure. So I spoke, I think it was yesterday, about stagflation. I think that's why the miners are such a great place to be, and I think a lot of people don't the mainstream they don't get the stagflation. Just like in the 70s, I've read, Clive, that no one expected uh, there to be inflation and the economy not to be doing well, which was stagflation, and it seems like they're making the same mistake again.
Yeah. I mean, perhaps if I just continue a little bit on the gold theme, why is the gold going up? As I said, it's not the man in the street. We know that for sure because we look at the gold mining ETF, not the gold mining, the gold physical gold ETFs with the gold falling. So, but yet we have record deliveries coming out of COMEX, which are 100-ounce bars. That is not mom and pop stuff. These are $250,000 bars, $500,000 bars. So whoever's buying that is a major institution. It could be, for all I know, it could be Berkshire Hathaway, it could be a government. We don't know. But someone out there, big buyers, those who know, are buying that. And of course, we've got ongoing the continued buying by central banks who literally do not care what price they pay. Because the dollar has been weaponized. Central banks are saying the US debt is out of control. We've got all these treasuries. What do we do when we can't get paid? When they block us? Maybe we might be friends with the United States today, but what happens tomorrow? You don't know where the world's going. We've got a man at the helm who seems to relish in making friends with his enemies and enemies out of his friends. Let's get while we can still get our hands on it, let's get some gold. So I think that buying of gold by central banks is set to continue, and sooner or later the man in the street will come in. And when the man in the street does come in, he's bigger than the central bank buying. Collectively. So I think that the gold price is very well underpinned. So it doesn't really matter to me whether we go into a recession or not from a price standpoint of gold. I think the gold price is very well underpinned by the central bank buying. And then we've still got this catalyst, this kicker, that maybe the man in the street's going to come in and start buying down the line. I think that is a likely probability, but we're not there yet.
Yeah, and you said that central banks don't care about the price. They just want to buy the physical. And I was reading that article about China and the resource wars in the FT. And I think the region in China that is the biggest commodities producers is Xinjiang, I think. Is it where in the Western China, I might
Shenzhen, yeah.
Beijing. And they say a lot of the local governments are involved in helping this. And the other thing it says is that China has, I think, pumped $57 billion into going abroad and investing in mining projects around the world, and that they don't really care about how much they pay because for them it's strategic. So the government wants, even if they're losing money by how much they pay in 1 year or two, they don't care. They care about having the commodities, and I think it's the same thing for gold. They don't care about the price. The insurance is more important. And I think it should be for us as well as individuals. Yes, you should try to buy gold whenever you can, but also maybe when the prices come off a bit, dollar cost average. And the other thing, Clive, I would say before we wrap up, all this that we've been talking about is not financial advice. It's just our opinion, and the viewers should do their own homework, research, and decide for themselves, right?
Yeah, I mean, this is what I do. Before I buy a company, I look at what the company is doing. I read the last quarterly report. Well, actually, to tell the truth, these days I use artificial intelligence to do that for me, so it goes a lot faster, and then it will give me a quick summary. But you have to look at what you're buying. My advice, if you are buying companies, is only choose companies which are making a profit. Only choose companies where you understand what they're doing and you like what they're doing. It doesn't mean to say you have to be a customer of them, but if you know what they're doing and they are making a profit, you're onto a good you're on a good road. Obviously, the best thing you could do of all is to buy a company which is relatively cheap, and there's lots of ways of measuring cheap, but price earnings ratio is one of them, but which has the probability that it will grow. So that's called a PEG ratio, price earnings growth ratio. And what you want is what's called the lowest price earnings growth ratio. Of course, you've got to have both figures have got to be plausible. In other words, a low price earnings ratio and a high growth ratio, that will give you a low PEG ratio. And then those are good companies to buy.
And how's the growth ratio calculated?
Well, there's lots of ways of looking at that. There's websites which do it for you anyway.
Okay.
But the way I look at it as growth in sales more than growth in earnings, because earnings can be easily manipulated. For example, if you have a lot of inflation, your stock might rise in price, but that's not really a profit, even though it can be booked as a profit and called a profit because they're selling the finished product for more, but they have to buy the new product for more. So it's not really a real profit. So what I'm looking at much more importantly is the changes in the level of turnover. Is that rising, and is it likely to rise in the future? That's what I'd call growth.
So I guess in the mining company would be how many ounces the company is producing is growing.
That's right. And in fact, in one of the companies I bought, I won't say the name, I discovered that, well, it's written in black and white, that the amount of gold they're going to mine next year is going to be about 50% more than they mined last year, because it was more of a younger company. But now it's
Yeah.
ramping up.
Just one, maybe you can tell us what was the American company that's worth 50 billion in market cap?
That's Newmont Mining.
Yeah, that's what I thought.
You probably guessed.
Yeah. Great, Clive. Hopefully, you'll be able to make it on Sunday for the live stream. Uh,
Yes, I think so, Mario. I'm looking forward to it very much.
I've got hopefully Rafi and Phil Lowe, who I did an interview with the other day. He's
Hmm.
a friend of Rafi, so hopefully we'll be four, which is interesting. And yeah, and I wish you a great weekend, Clive, and to the viewers as well. And we'll talk again on Sunday.
Thank you, Mario, and have a lovely weekend until Sunday night. And bye to all your listeners.
Yeah, goodbye.